In this video, we're going to look at why the central bank does not have absolute control over the amount of money in circulation. Let's take a look. If we could imagine a world without banks, we would think that the total amount of money in circulation would be a combination of all of the paper bills and coins that the central bank has produced over the years. That would be the total amount of money. So if they printed like $1 million worth of money, that money would be within the population, and that's the total amount that's available. So if you wanted to borrow money, you could go see other friends that have an excess amount of money and borrow from them, but you're limited to that. These days, though, the central bank has some control over the money supply, but there is a lot of outside effects by the commercial banks. So commercial banks, when they receive deposits by you, me, anyone else, they keep a portion of that deposit as reserves. So the reason they keep a portion as reserves is that at some point you may want to take that money out and they want to be able to give you that money. They want to keep a portion as reserves. Well, some of you might wonder, well, why don't they just keep it all in their banks? Well, the thing that they've realized over time is that if all of us have $1,000 at the bank, we won't all take that money out at the same time. So because of that, they could only keep a portion of those deposits as reserves and still be okay to meet those transactions, those withdrawals that you may have. They could then use that money for valuable purposes. And that valuable purpose is to make out a loan to someone else. So let's say there's $100,000 that's been deposited at the bank. They keep, let's say, $1,000 as reserves, and they loan out the other $99,000. Well, the people who take out a loan don't just take out a loan to leave the money on their desk and do nothing with it. When you take out a loan, it's to make a purchase. So as you take out a loan to buy a desk, a car, whatever it may be, well, that person that receives that money can decide to do something else with it. But if they have no purchases to do in the short term, well, they're possibly going to put that money into the bank. So as that $99,000 worth of loans comes out, makes purchases, if these people don't keep any of this cash as cash and they deposit the rest, we'll see that if they keep a portion, that would be like the cash drain ratio. But if they deposit it all, well, now we have an extra $99,000 in deposits. And with that $99,000 in deposits, well, then the bank will keep a portion of that as reserves. It could be 1% or another percentage, and then they're going to loan out the rest. And then this kind of process repeats itself, and it ends up leading to a much larger figure in terms of money in circulation than if there was no banks. Because if there wasn't no banks, you'd be limited at $100,000 available in total. And now with this process, it could be a lot higher. The money multiplier formula is 1 over the reserve ratio plus the cash drain ratio. I'll get back to the cash drain ratio later, but let's just assume it's equal to 0 for now, that cash drain ratio. And if the reserve ratio was 1%, well, it'd be 1 over 0.01, which would be equal to 100. So that initial $100,000 gets multiplied 100 times, leading to a situation where there's actually $10 million available in circulation. So you have a much greater amount of money in circulation than the initial amount that was created by the central bank. So that's why we say that the central bank has some impact on the amount of money in circulation in terms of printing more currency, but there's a lot of total amount of money that's available that is determined by commercial banks. Because if all of a sudden those commercial banks decided to keep on like 5% of their deposits as reserves, well, then it would be 1 over 0.05, which would be 20 times instead of 100 times. So the money supply goes down from like 100,000, which no central bank, when it was a 100 multiplier, it was 10 million. And now with only 20 of multiplier, well, that 100,000 is 2 million. So there's a lot less money in circulation. And so as the cash drain the reserve ratio falls, how much they keep as reserve falls, the amount of money in circulation goes up. And in a separate video, we kind of talked about that idea between interest rates and whatnot. And typically when interest rates go down, banks don't mind missing out in terms of having to borrow in the overnight market as much. So they'll typically loan out more. They won't keep as much as reserves. And in those instances, it's going to lead to much more money in circulation. That's the initial idea of how this money multiplying process works. If we just want to add the extra element, the cash drain ratio is this idea of, well, if you receive $100, do you deposit it all in the bank? If you only deposit half of it, well, then that multiplying process is quite diminished, because out of that, let's say, $100 that you receive, instead of putting it in the bank and all of that leads to more multiplication, it's only $50 that goes into the bank. And because of that, that whole impact is quite smaller. So the overall formula, if you're given a reserve ratio and a cash drain ratio, is going to be money multiplier is equal to 1 over reserve ratio plus the cash drain ratio, which is also a percentage. So let's say the reserve ratio is 10%, it'd be 0.1, and let's say the cash drain ratio is also 0.1, well then it'd be 1 over 0.2, which would be money multiplying process of 5 times the initial amount of money in circulation. So those are the two big factors that will have an influence on total money available that is not controlled by the central bank. So hopefully with this video, you'll understand that the central bank has control on the money in circulation, but they don't have absolute control on the money in circulation. And some of you might argue, well, we can force the banks to keep a certain amount of money as reserves, and that has been done in the past. In Canada, it's been done since up to 1994, I believe. But the problem with that is, even if you set a minimum reserve ratio, it may mean that the banks keep enough reserves, but they have the incentive to do so as well, because if they act riskily, they owe more money to the CDIC, the Canada Deposit Insurance Corporation. But let's just put that aside. Even if you were to set a minimum, unless you also set a maximum, it doesn't mean that the commercial banks will not keep more reserves than what you're setting. So you could say, well, we'll set a minimum of 10%, and that way this is the amount of money that's going to be in circulation. Well, what happens if the central commercial banks keep 20% in reserves instead of 10%? So in that case, you would have a lot less money being multiplied if they decide to keep more reserves. Same thing for us who decide to keep a portion of our deposits in our pockets versus depositing it at the bank. Well, you can't really control that amount of money. You can't force citizens to deposit all their money at the bank or to keep a certain portion. So that also has a big impact on total amount of money in circulation available. So there is a lot of things at play that determine how much money is available, and it's not just based on what the central bank does. They have strong influences by changing rates. It has different incentives on commercial banks to either loan out more or less, and on consumers to keep more, and so on. But they don't have absolute control. So hopefully you understand how that works and how money supply is determined based on these two big forces. Have a good day. If you found this video interesting, please consider subscribing or joining my class where I guide you to apply and expand on the information found in these videos to real-life examples. Have a good day.